And with that, we're going to welcome a new presenter today. We have, excuse me, we have Dermot with us, Dermot O'Neill. He's the president of Dermot O'Neill CPA PC and has over 40 years of experience as a certified public accountant. He has concentrated his practice in areas of forensic accounting and litigation support, business valuation, transaction consulting, financial analysis, and income taxation. He's been a guest lecturer at Lehigh University, at Widener University Graduate Schools of Business. And he's a CPA, an ABV, CFF, CVA, a MAP. He's a man of many colors and many distinctions. So with that, I will turn it over to Dermot. Thanks, sir, for being here with us.
Thanks, Wendy. Welcome, everyone. We're going to talk about fraud today. In preparing for this, it just dawned on me that my first case was in 1976, which was when I was a little bit more than a junior accountant, and followed that up with a divorce case in 1976 in Florida because I was the only young and single guy that could travel. I didn't really start into financial forensics until early 90s when I was with a firm in Wilmington, Delaware. And one of the partners was looking to retire and he did a lot of divorce litigation. So I kind of took over from him and then got more education and actually did this full time with some national firms from 1998 forward. And since 1998, I've been doing nothing but business valuation and investigation, litigation, and so forth. As with a lot of you, I'm now getting involved in depositions and testimony online in the internet world, in the Zoom world, and so forth. I have done depositions which were done with video and no attorneys were in the room. One attorney was in New York, the other attorney was in Los Angeles. I was in Wilmington, Delaware at an office and only had a stenographer and a videographer. So things are changing rapidly in our profession. Learning objectives for this particular program, we're looking at a 30,000-foot view, if you will, about business fraud. And the objectives of the program today are to understand what fraud entails. We will understand some of what fraud entails, but it's at such a wide and growing area. For example, we know in the last 3 months that many people have experienced fraud with their unemployment checks, where their identities had been stolen and people had applied for unemployment with the big layoffs of, was it 40 million people are out of work right now. And people are going to apply for unemployment and find out, oh, you've already applied. And fraudsters were getting checks. And the recent investigations that I read, which is about 2 days ago, are that most of this fraud is coming from Nigeria, and they're still doing investigations. There are tons of different types of fraud. It's only limited by the creative mind of the human being who's involved in perpetrating the frauds. Being familiar with common investigative techniques, we'll talk generally about common investigative techniques, and I put in the bibliography several books that go into investigative techniques in a great amount of detail. We actually have a fraud course through NACBA, which I think, if I recall correctly, is about 15 hours. And that's a very high view of the techniques used in investigating fraud. But the 2 books that are in the bibliography will certainly get you moving in the right direction. Red flags and other indicia of fraud, we'll talk about that. Financial statement misrepresentation, all the different things that can go on in that area, and be able to identify and use, not use, but identify the difference between prevention tools and detection tools. The prevention tools really are what we've experienced as auditors and systems of internal control. And a couple of cases we'll discuss very briefly where the accountants who are doing reviewed financial statements had all the information they needed to know that there was fraud going on, and they blew it. We find that auditors tend to use the engagement letter, since we're not engaged to detect fraud, we're engaged to opine on the fairness of the financial statements, that they think that's an out. It's not really an out, because if it ever goes to trial against an auditor, and I do one side job, I do a fair amount of accounting malpractice defense work for the insurance companies. But if you find that the audit did not discover fraud and goes to trial, you'll find that the juries tend to believe the publications that the AICPA and the CPA profession as a whole puts out, that we're trusted advisors. And if something went wrong, the trusted advisor must have screwed up. So we have those issues, but that gets back into prevention. There's also detection tools which are based upon what we learned as auditors, analytical procedures and so forth. So that's generally how we're going to go today. We may take a brief break depending upon our time period, but we'll see how that works out. Basic fraud concepts is the wrongful deception intended to result in financial or personal gain. Now, that deception may be criminal or it may be civil. And what I mean by that is that criminal is when you will get thrown in jail if you're found out to have committed fraud. Other types of fraud which are committed on a civil level or just limited to a civil level are typically situations where there's been a fraud detected. Maybe a CFO or a bookkeeper has stolen some funds from the company, and the company said, "Look, I just want to fire them. I want to file a claim for insurance under my bond policy." What happens then is you may be called in to determine the loss that's to be submitted to the insurance company, and also to make sure that the loss submitted to the insurance company fulfills their criteria. So there's a broad range of wrongful and criminal and so forth. But the key thing is, it heads down to the last bullet point, is that in order to have something that's fraudulent, there's got to be intent involved. And if we're involved with criminal fraud, the issue always comes up as to whether we as investigators are competent to determine intent. And usually the answer is no, because the determination of intent within the context of fraud is up to the fact finder, be that a judge or a jury. And if we try to, or if our counsel attempts us to opine on intent, more likely than not, that'll be thrown out. That'll be thrown out of the case because we are just not, there's no training to define it. There's no training to determine intent. Intent is determined by the jury, the fact finder, when they hear all the evidence that's being presented. Material, the item in question must matter to the person relying on it, so that fraud generally is not something that's insignificant. It's got to be material. Intent, as we just indicated, is difficult to prove and is determined by the fact finder, but yet there are tons of attorneys out there, when they engage you to prosecute a fraud case, that, yeah, I need you to let me know if this is fraudulent or not. Well, you can't do that. If you do it and the opposing counsel is sharp, your reports will get thrown out. And one thing, when I talk about this, I explain to experts in report writing and so forth, the key thing between say a lost profits report or a business valuation report and a fraud report is that in the case of lost profits or business valuation, we express our opinion as to the amount of lost profits or the value of the business. When we're doing a fraud report or an investigation, we express our findings. We found X number of checks that the payees didn't match, or whatever it happens to be. We have double signatures, but they only had one signature. We express our findings in these kinds of reports, and then we testify to those findings, and it's up to the judge or the jury to determine whether or not there was fraud and the extent of the fraud. Damages, not always financial. Businesses get damaged, but may not be measurable in terms of dollars and cents. And then the bottom bullet point says, we as experts may not be able to opine on the intent of the perpetrator. Little bit of history. The concept goes back to 1939, but fraud really has been around for quite a while. And as indicated in the last bullet point, that as far as fraud is concerned, it's been around for a while, but the underlying character of white-collar crime has not been around. And we're talking here primarily about white-collar crime. And white-collar, call it white-collar theft, because at the election of the party that was damaged, it may not ever go to a crime. I have a good friend of mine that does a mostly criminal investigation, and they're all pretty big, but a lot of his cases involve where governments were defrauded, or there was kickbacks on government contracts, or there was a local county or township administrator that was stealing, that kind of thing. But anyway, it's been around for quite a while. The ACFE, American College of Forensic Examiners, puts out publications periodically relative to the significance of fraud. Now, these are significant because I see we've got a polling question up.
And Dermot, you can just X that out and close it on your end. You don't need to stop or anything for it.
Okay, just because I just was getting going there. Anyway, there's some significant concepts here, significant results here in the ACFE studies that you want to keep in the back of your mind. It's not so much that the number of cases, there's a lot of them. It's all over the world, and there are tons of, it happens in different industries. The key thing is right in the middle. It says that the median loss per case is 130,000. Median is half or above that and half or below that. And 22% of the cases are in excess of $1 million. So the vast majority of fraud cases, you're looking at 6 digits, $200,000, $300,000, $400,000. And those are more likely than not the ones that your practice may get involved with. The $1 million cases are typically financial statement fraud, large contract cases where there's large amount of kickbacks and that kind of thing, which your firm may or may not get involved with. Fraud schemes, the duration of a typical fraud scheme is 16 months. In my experience, I've had them up to 10 years. So that 16 months is what it was in 2018. That may be good because perhaps they're catching fraud earlier or discovering it earlier. I don't know the reasons for that. And then corruption was the most common scheme in every global region. The key thing is that what they're suggesting here is that the individual involved has to be corrupt to begin with before they get into fraud. And we'll see that a little bit later. Oops. Now, the background of business fraud. On the left-hand side, I think the second one down is the, or not the second one, but the left side is the important one. Asset misappropriations. The median loss was $114,000, and that was in 89% of the fraud cases. The financial statement fraud cases were 10% of the cases, but the median loss was $800,000. So you can see that there's a significant difference between those two types of losses. Now, with the asset misappropriation schemes, $114,000, you're the owner of a business, and you find that the bookkeeper or the CFO or controller has ripped off for $114,000. The question you have to raise is, are you going to prosecute? Are you going to call in the district attorney's office or the cops for $114,000, or are you just going to fire the person and file a claim on your insurance contract? That's a decision that has to be made. Many, many times, the owner of the business will say, I'm not going to, I'll report it to the police, I'll report it to the DA because that's needed for insurance purposes, but they may not pursue it with the DA because obviously the DA, district attorney, is not going to pursue the case unless the owner of the business is going to work with them to provide the information and so forth. So small business lost almost twice as much per scheme to fraud. We have 104,000 was the median loss where there was more than 100 employees, and there was $200,000 was the median loss where there were less than 100 employees. And I found out that again, in my experience, which may or may not be worth much, but in my experience, the small businesses don't have internal control. So consequently, the frauds can go on for an extended period of time, and they're not necessarily caught. I'll give you a classic example of a significant one. I was called in a case probably, and this covers a lot of range, so I'll give you a lot of detail about this particular case because it was actually involved accounting malpractice. Situation was a construction company, and the accountant was doing reviewed, accounting firm was doing reviewed financial statements and also preparing tax returns. During their tenure, they did as they're supposed to do when you're doing reviewed financial statements, they did analytical procedures. And year 5, we'll say the gross profit percentage was 20%. Year 4, up to the date of discovery, was about 18%. Year 3 was 16%. Year 4 was about 12 or 14%. Or the next year was 12 or 14%, and then it was down to about 10%. At that particular point in time, the accountant said to the bookkeeper, how did the gross profit go from 20% down to 10% in 5 years? What's going on? And this was during the time of the recession subsequent to 2008. And so the bookkeeper said, well, this is a construction company. We want to keep our workers busy. So they've been underbidding contracts. And they've been reducing the gross profit on contracts. So the accountant says, okay, and went ahead and issued the financial statements. The following year, the owner was opening a bank statement, which he hardly ever did, and found a check made out to the bookkeeper for a couple of $1,000s. He had no idea what it was for, called in the district attorney and the police, and they found out that the bookkeeper had stolen $900,000 over a 10-year period. And so the company then decided to sue the accounting firm because they didn't pick up on it. And, the issue was, from an accounting liability standpoint, was the decrease in gross margin, gross profit percentage. Well, it only went down by 2%. Went from 20% to 18%. But as investigators, that's a 10% decline. A decline from 10% down to 18% is a 10% decline, but in the mind of the way we're trained as accountants, it was only a 2% decline, 20 minus 18. The second major area that there was a problem was the fact that if you look at your review standards, they say that if you have a question, you should ask management, and bookkeepers are not management. And so but again, as accountants and are training in relationships and so forth, most of the time we go to bookkeepers for questions. So those two things, they prosecuted. She is now doing, if I recall correctly, 14 years in jail. and of course has orders to repay the money and so forth. So those are the kinds of situations that the smaller companies get themselves into. In this particular case, as I say, it was $900,000, but it was over a 10-year period. So with smaller companies, you need to be careful. It's not going to be too obvious. Now, on the right-hand side, we have over the past 10 years, occupational fraud referrals to prosecution declined by 16%. And again, one of the reasons is fear of bad publicity, because if it goes to the police or the DA's office, district attorney's office, it's going to hit the papers. And fraudsters who had been with their company longer stole twice as much. Again, with this bookkeeper, for example, she was there for in excess of 10 years, and she stole $900,000. Again, with smaller companies, the issue tends to be lack of internal control. Oops, excuse me. Fraud framework. The frameworks are designed to help explain the elements that enable the existence of fraud. In other words, if you're looking at a situation, what are the facts in the situation, the elements in the situation that would be an indicator of fraud? And theoretically, if these indicators are not present, suggests that fraud is unlikely to exist. Doesn't mean it won't exist, but it means it's unlikely to exist. Now, these are generalities. The issue is if you, for example, I was not frequently, but in my earlier days, frequently got called in to do reviews of internal control, etc. Particularly with an eye towards fraud, but it was sold to the clients based upon, if we do this internal control investigation, your numbers will be more reliable. But really it had to do with fraud. It was the way the firm was selling fraud services without calling them fraud services. So these are the three. The fraud triangle is the one that's most commonly used, most commonly discussed. There's a fraud diamond and a fraud pentagon. The fraud triangle basically has three components. First being opportunity, the chance to commit the fraud as well as to cover it up. Bookkeeper, CFO, etc., all classic positions where the fraud opportunity exists itself. Pressure is another one. A perceived need or motivation to commit fraud. Again, common ones. Gambling is a big one. It's a frequent one. Lifestyle is another big one. We have locally here, we had my friend was doing the criminal investigation on it. There was a local county manager. I think she was the controller of the county or something like that. She stole $4 million purely because of a lifestyle that she desired. She thought she was due this lifestyle. And so she used most of her money, a little bit of gambling, but most of it on cars and houses and clothes and all that kind of good stuff. And finally, in this step, there's the rationalization process, which the thief, in his own mind or her own mind, makes it that this fraud is okay. It's okay to take this money. Rationalization. So those are the three parts of the triangle that are typically discussed when we're discussing fraud. And so, is there an opportunity? Is the person under pressure to need money? And finally, is the person corrupt enough to be able to rationalize the fact that they're stealing this money? Now, the other ones are slightly, pretty much similar, but they have a couple of additional terms. Under the fraud diamond, they throw in capacity. Does this person have the capacity to steal? And the fraud pentagon gets into the competence and arrogance of the person involved. Some of these fraud situations can get really complex, and you need to have somebody who's really competent in order to do it. I had a case where I was actually a consulting expert for the law firm, where the CFO of a it was a publicly traded company, a well-known publicly traded company that went private. They were bought out by a private equity fund. And the private equity fund, about 6 months or a year afterwards, found out that the CFO had been ripping off this publicly traded company for a number of years. And my recall may not be accurate, but it was several $1 million that was ripped off by the CFO. But his process was really complex. It involved payroll. It involved payroll departments. It involved liabilities, overstating, understating accounts payable, et cetera, et cetera. So it was a relatively complex process. So in that particular case, he had to have, he needed to be relatively competent in order to pull that off. And of course, arrogance is kind of goes into the area of corruptness, arrogance, corruptness, those kinds of things, personal traits of the people that are involved in the program. Occupational fraud, we talked about corruption, whether or not a person is corrupt, improper influence over a transaction to the detriment of the employer. In other words, you're getting a paycheck from this company and you could care less. You don't mind hurting this company from a financial standpoint. And it's difficult to, a lot of times what you see in these smaller companies is they recognize that there might be a problem with this person, but they just don't want to do anything about it. It's kind of like the ostrich theory. They want to stick their head in the sand. Yeah, we know there might be a problem here, but we don't want to look too deep. We don't want to scratch the surface because, he's been around for a while. He's important to the business, this, that, and the other thing. You have asset misappropriation is basically defined as a theft or misuse of assets, such as cash and inventory. And asset misappropriation can get relatively complex. Like the case I was just telling you about with the publicly traded company, where the asset misappropriation covered areas of, ultimately it was cash, but it was being hidden by different things like payables and payroll and so forth. And finally, financial statement fraud is a manipulation of a company's financial statements and disclosures to deceive users of the information. One issue, I'll give you an illustration of a case where a lot of people I know knew the perpetrator because he was a CPA, and it was an interesting case. Because some of the local CPAs were up in arms about it relative to intent. And this was a company that had a lot of debt, was struggling somewhat, and they had bank borrowings and they had benchmarks that had to meet in order that the loans would not be called and so forth. So the individual who was a CFO, wanting to help the business and have the business not have any loans called, did what we call bill and hold. That's a situation where a customer might say, okay, fine, I'll give you a purchase order for 50,000 units this year, but I don't want them released until we tell you to. And it'll be over the period of 12 months or some period of time. Maybe it'll be 2 years, depending upon the facts and circumstances. So what the controller did was he set up a billing for all 50,000 units at the point in time that they got the purchase order. So you had this buildup of sales or billings translated into sales, which really didn't exist, but they showed up on the income statement as revenues, and of course kept the company from violating any of the loan obligations or loan restriction, loan requirements, I guess the best way to put it. Well, this kept happening for a number of years. I think it was like 3 or 4 years, if I recall the facts correctly. And it finally blew up. And, there was no money to pay the banks, et cetera. They called in the feds. The feds investigated. The feds prosecuted this guy under the criminal statutes. and did it for, I think he served 4 years in jail. He's out now. But a lot of the accountants in the local community were saying, well, there was no intent. He wasn't intending to hurt anybody. Yes, he was. He's intending to deceive the users of the information, which were the creditors. The fact was he didn't put any money in his pocket. They didn't understand that. He didn't put any money in his pocket. How can it be fraud? It was fraud because he was deceiving the users of the financial information. The fraud tree, just as an elaboration, and my eyesight can't read all this stuff, so I'm not going to read it to you. You can take a look at it in your screens, in your 24-inch screens, your 27-inch screens, or what you might have. But it just basically talks about corruption, asset misappropriation, financial statement fraud, indications of corruptions or conflicts of interest, bribery, illegal gratuities, economic extortion, financial statement fraud, net worth, net income overstatements, which is an illustration of what we just talked about, net worth and net income understatements. So these are the general areas that you're going to find fraud in. And this is not all inclusive. These are frequent areas that you'll find fraud in, but it's certainly not all inclusive. I'll talk for a minute very generally about corruption schemes. Some of the schemes that get involved with fraud. Bribery, for example, involves kickbacks or bid rigging. Economic extortion is the practice of obtaining something, especially money, through force or threats. A lot of time, economic extortion is used by perpetrators in order to keep perhaps somebody has a secret about their business that they don't want anybody to know, but somebody knows about it, so they will threaten economic extortion. We'll squeal, we'll tell, unless you pay me money. It's used by the old Cosa Nostra back in the day when they were I think they're still around, but they're not around as much as they were, if I recall recent studies and so forth. But bribery and bid rigging are quite common. Kickbacks, quite common. I've been shocked about how common they are in government and actually what they are in government. I'll give you an illustration. One of my clients years ago had government contracts with AT's Army and Air Force services to cut hair on military bases. And his contract basically was what percentage of sales he would give to the local base, et cetera. And it was, he had several really big military bases where he cut hair. He cut the hair for the people just coming in, the recruits. He cut hair for the officers for fees, et cetera, et cetera. And he had a big competitor in the industry. There's still big competitors in the industry. But what was happening was that when the decision makers in APs in the government, which was, generals and so forth in the Army, Air Force, et cetera, they would get a job at retirement with his competitor. So it's not a kickback in terms of money that we typically consider kickbacks, but here's situations where people who are making the decisions to have a government contract or to how to treat a government contract are being romanced, being hired at their retirement from the government by these people who they were currently negotiating with and so forth. That's a common situation. I've seen it with IRS agents who get their 20 years experience and then they go to work for a CPA firm or a law firm and getting well paid, and what they're being hired to influence the current IRS agents that might be examining or investigating something. So yeah, this is not exactly kickbacks, but it's kind of similar to the kickbacks, if you will. And it sometimes becomes fraudulent where the kickbacks become, or the compensation becomes way out of line from the professional services that are being rendered. Bid rigging. This is, again, a common situation in construction, a common situation in manufacturing and so forth, where, if you give me I guess I'll give you a classic example that I had was with a cousin-in-law who was in construction in New York, and he wanted to expand his construction business over to the Philippines, and for particularly highway construction. And he was, you got to talk to the corporal. And then he talked to the corporal, and the corporal says, oh, you got to talk to the sergeant. But to talk to the sergeant, you had to give the corporal a couple $1,000. And then you go and you talk to the sergeant. Oh, you got to talk to the captain. Oh, okay. In order to talk to the captain, you got to give the sergeant a couple $1 million, et cetera, et cetera. It got to the point where he was paying out $50,000 and $100,000 and getting nowhere. That's an example, classic example of kickbacks. Bid rigging is situations where you've got, supposedly bids, and you don't get the lowest bid, you get the highest bid. You take the highest bid because somebody in your organization who has a decision-making authority is getting a kickback on the bid. And the price includes the amount that's being kicked back to your employee. So there's all kinds of variations on bribery, tons of it. Oops. There we go. Now, these are defined: bribery, giving something of value directly or indirectly to influence the actions of someone. If I'm giving you a job and you're a general in APHES and I'm giving you a job, and once you retire, is that giving something of value directly or indirectly to influence the actions of another? I don't know. That's not EFC. That's a factual situation. Kickbacks, we talked about company overpaying for goods and services. Vendor gives part or all of the overpayment to the perpetrator. That's where the bid includes the amount of money that's being given to the perpetrator. And then bid rigging examples: vendors collude in the business process. Vendors given an advantage in competitive bidding process, and so forth. So these, again, are quite common elements in fraud cases. What are some of the red flags of bribery? We've talked about some of these earlier. Undisclosed conflicts of interest, that gets into the corruption angle. Employees, executives, or owners exert material influence over transactions. These are common situations where there's somebody sitting around the table in the company who's really pushing to get the bid to somebody, even though they may not be the lowest bid, or maybe their bid has been missing some information, shall we say. The bidding process that's used in the company does not include mechanisms to promote competition. Relationships between vendors and decision-making employees. This happens frequently in businesses, particularly in closely held businesses. Maybe dad is the shareholder and junior's working there, and junior's got a deal going with vendors, and dad is allowing son to make some of these business decisions. Those kinds of situations. And prior sanctions for violating the FCPA. FCPA is the Foreign Corrupt Practices Act. That gets involved, back to the illustration that I gave you about my cousin-in-law who was giving out bribes in the Philippines in order to get work. If that had gone to litigation and he was found guilty under the Foreign Corrupt Practices Act, that would be an indication that he would be somebody in your organization to watch out for. Some asset misappropriation schemes. And we'll talk about these. Cash skimming and cash larceny, that basically comes down to when the money is taken, before or after being recorded. Cash disbursement schemes, payrolling schemes, and expense reimbursement schemes. We'll talk about those in some detail. Cash skimming is basically stolen at the point of entry. It's done before the cash is recorded. That's what we mean by before the point of entry. And it's difficult to detect because it never hits the books. It's off the books. Obviously, the common examples of this are the pizzeria, where people come in and buy a pie for $15 and then pay for it in cash and walk out the door. Hair salons, typically situations where people will pay for services in cash. Now, years and years and years ago, probably 30 years ago at this point, I had a dentist client who had been, before he became a client, had been investigated by the Internal Revenue, audited by the Internal Revenue Service, and the auditor made adjustments of $5,000 on his income. And I said, well, how come they made the adjustment? What the auditor did was, he said there was no cash deposits in this dentist's business for the entire year, no cash deposits. So the auditor, IRS auditor, said basically, look, people pay dentists occasionally in cash. And the fact that there was no cash deposits on the deposit slips indicates that you were putting cash in your pockets and they agreed to accept $5,000. So that's basically cash skimming. It's cash taken before it ever hits the books. Cash larceny, or just larceny in general, is stealing cash after it's been recorded in the accounting system. And the key thing about that is requires accounting entries to cover the theft, whereas cash skimming does not, because there's no accounting entries. Now, one of the areas that you'll get into in cash larceny is looking at the entries in the books and records. Do they make sense based upon what you know? I had a case maybe about 10 or 12 years ago with a large food market. And it was a larceny, if you will. We had, when the people that checked you out would bring their drawers in to the office, they would have credit card slips, and they'd have cash, and they'd have food stamp cards, debit cards for food stamps, etc. And then there would be a tape which would have all of these summarized: so much in credit card sales, so much in food stamp sales, so much in cash sales, etc. And they bring it into the office, and then a person in the office would go through the drawer and double check everything, and the drawer would be either over or short. And then that person in the office would bundle up the records and send them to the accounting department. The accounting department would record them. Well, what this person in the office was doing, the way the tape from the cash register was set up, is that this was a cashier, not person in the office, the cashier. The way the cashier would work is that the food stamp printout was on the bottom, so they bring that into the office. The office would sign off on it and say, okay, fine. Then the cashier would take it and clip the bottom of the tape, which had, let's say, $500 of food stamps, and then take $500 out of the cash part of it and submit that to accounting. So the accounting was getting the sheet that said there was, $500. It said so much in credit cards, so much in cash, and so much in food stamps. And what was happening over a period of time is this person was stealing, I believe it was the cashier, hundreds of dollars a shift, hundreds of dollars a day. Usually they're on one shift. And what was happening is, and this is something we'll talk about a little bit later, what was happening over time is this was growing. The problem was that nobody in the accounting department was ever reconciling anything. They were never reconciling the tape, because what they would do is, they'd show the sheet that was made up by the person in the office, but then they would never look at the tape, and they would see that they were unable to see that the tape at the bottom cut off of it. So this is an example of requiring accounting entries to cover the theft. The accounting entry, of course, was the tape that never hit the accounting department. Red flags of cash receipt schemes, not proper security. That's what was happening in this case, because the information, the package of information from all the cashiers was just put in the safe, which was available to anybody for a week before it was ever sent to the accounting department. Infrequent bank deposits. Bank records don't tie to deposit slips. The presumption in the company is that you've got somebody who's attempting to tie the bank deposit slips in the bank records. You've got somebody in the company who's looking for the deposit slips that they're not missing. The illustration I gave you about the dentist, there's no cash in the deposit slips. And you have to have somebody, again, in the accounting department that's looking for that. Delay in recording bank accounts, lag in recording journal entries or cash receipts entries. In other words, Monday's cash receipts aren't recorded till Friday. Bank accounts don't reconcile missing or voided receipts. And cash shortages or overages in the register. Cash shortage in the register, there's going to be some cash shortages or overage in the register, but there's got to be some kind of a range that's experienced by the company. For example, I had a case a while back where, every salesperson who was involved with the register, when they close out, there might be $5, $10 over or short in the register, but one person always had $100, $125. So those are tip-offs that there's an issue. And to give you an idea of how some people think about these cash schemes, way back when I was in college, which was a long, long time ago, I pumped gas at a gas station. And we had a cash register that every person that worked in the gas station had their own drawer. They were the only ones that could open the drawer. That's where you made change, etc. So that as far as the owner was concerned, if you're going to steal from somebody, you'd be stealing from one of the employees and not from him. So that, these are the, you spend, I think it cost them $3,000 or $4,000, if not more, for this particular type of register. So these are the extent that some companies will go to taking care of some of these cash schemes. Payroll schemes, falsified wages. Many times it's common for somebody who's in charge of the payroll department to falsify their own wages because nobody's looking over their shoulder. Again, no internal control or limited internal control. Ghost employees, situations where, and it happens frequently, where an employee is terminated, but the payroll department doesn't terminate them from the payroll records. And somebody in the payroll department is walking home with a payroll check. I had a case like that probably 2 or 3 years ago. And it was involving, I was representing an insurance company where there was a claim filed. And that's exactly what the employee was doing, was a CFO. And every time an employee terminated, they would still be on the payroll file and still get a payroll check. And this person was then going to the bank and cashing the payroll check with falsified signatures on the back. Expense reimbursement schemes. Overstated expenses are quite common. Fictitious expenses are quite common. Multiple reimbursement, not as common as overstated expenses, because somebody in the accounting department will usually say, well, we gave Harvey $500 last week. How come he's got another one for $500? He shouldn't have that much, those kinds of things. Overstated expenses are quite simply padding your expenses. Fictitious expenses, expenses that you didn't pay for. Again, these generally will happen where there's a relationship between somebody who's in the accounting department and somebody who's getting expense reimbursements. Now, we won't go into those schemes, but it's quite common. Look at relationships. I was doing an audit probably 30 years ago, and there was a relationship. The vice president was very proud of the fact that he hired ex-cons for the accounting department, and we said, "What are you, nuts?" And he had just hired one guy who was, no, don't worry about it. He's taking care of inventory. Okay, fine. He's taking care of inventory. He's not touching cash. He's not touching checks. He's not doing anything. He's taking care of inventory. And a couple weeks later, we were working late one night. We saw the lights go on in the president's office, and we were walking out the door and say goodnight to the president. And who's in there on the couch but the cash receipts clerk and the inventory clerk? And we said, well, let's take a look at this. And we found out that going back a couple of weeks, there was cash shortages. So that the cash receipts clerk and the inventory clerk had a relationship going. So anyway, there's all kinds of schemes that go on here. Again, usually large expenses. Now, one of the, and large expenses we're talking about here in the books and records. One of the key things that I found is that to investigate this stuff, you need to do ratio analysis. You can't just be looking at dollars and cents or increases in dollars and cents. We need to be looking at ratio analysis, comparing expenses to revenue, comparing one kind of expense to another. Those kinds of ratio analysis. A lot of newbies, if you will just look, oh, payroll went up by $1,000. Let's take a look at that. The ratio analysis is more descriptive of what's actually going on than looking at the absolute dollars. Expenses exceeding budget amounts. Certainly that's a red flag. Again, to give you an idea of how some companies look at that, my brother-in-law is a partner in a CPA firm. When he was an intern in college, he worked for one semester as an intern with Boeing. And his job at Boeing was to determine why in a particular expense category there was a difference between budget and actual of $25 or more. And that was Boeing. And they were looking at budget versus actual of $25. Now, admittedly, that was a couple of decades ago, but it gives you an idea of how important this is to some companies. Disbursements in large round amounts. Multiple vendors with similar names in a system. That happens frequently. Again, it's a tax illustration, but it's an illustration nonetheless. Years and years ago, our tax director had an IRS audit, and the IRS was questioning a contribution of some $5,000 or $10,000, and the director got these checks from the client, and the checks were made payable to United Funds, F-U-N-D-S. Not United Fund. And United Fund, when he investigated, found that happened to be a United Kingdom mutual fund. And the guy was trying to deduct his check to United Funds, the mutual fund, instead of United Fund. So similar names can be an issue. Multiple addresses for the same vendor is a big tip-off. Employees with no benefit elections. The query there is, if you have benefits, why aren't you taking them? And expenses fall just below a threshold requiring receipt. That gets back to something similar to disbursements in large amounts. It gets back to cash deposit transactions, for example, which are less than $10,000. If they're more than $10,000, the bank has to report them. So all these limitations and all these schemes, usually they're very familiar with what has to take place. As we indicated in the beginning, and as it's indicated on the right-hand side, financial statement fraud causes the largest losses in the fraud area. And it affects more than just shareholders. Obviously, if there's some fraudulent situations that become public, the shareholders are going to get hit. But also it's going to impact the company's business and so forth. 800,000 on average. It's the costliest. The average length is 24 months. It's 24 months because much of the time financial statement fraud is uncovered by looking at the lifestyle of the perpetrator. Perpetrator typically will be somewhere in the office, the general office, the home office. Will generally have some control over the accounting records and will subsequently be living beyond what his means would indicate he could live at. And it's attributable to the downfall of many major companies and firms, WorldCom, oh God, I was thinking about it a minute ago, WorldCom, etc. One of the books that I've in the bibliography, Darrell Durrell's book actually uses Enron, excuse me, that's what it was, Enron as an illustration. And it's kind of like a case study as to how the problems with Enron could have been or should have been uncovered years before they went down the tubes. So, you know, the fraud and Enron case was, you know, liabilities that were not on the books, et cetera, et cetera. You know, it can cause the downfall of many, many companies, and I'm sure will continue into the future. What are the different ways, the different methodology? Tax manipulation, in other words, undercutting, reducing taxable income, I guess we'll leave it as simply that way. Misrepresentation or omission of information, improper recording of M&A, mergers and acquisitions, off-balance sheet schemes, which was Enron, inadequate or non-existing disclosures, improper valuation of assets, overstatement expenditures and liabilities, abuse and judgment and of estimates. Now, one of the questions that comes up frequently with financial statement fraud, particularly with public companies or large companies that are required by their banks to have audits or reviewed financial statements instead of just tax returns, are where were the auditors? And if you, PCAOB, which is Public Companies Oversight Board, does studies generally every year relating to auditors. And it's amazing that the reports that they study, approximately 52% of them had errors. And the errors were either in inadequate testing or inadequate files. In other words, they didn't document what they did if they said they did something. So that, you know, the auditors today have a tough time of it. It's difficult generating, well, I can give an example. When I used to teach auditing years ago, I'd go into the class the first night and say, if you want to be an auditor, you're not going to be liked, you know, because the only reason for the auditor's existence is to tell the CFO or the controller they did something wrong. So you're not going to be liked. So the issue is that auditors generally are not going to cover or not going to uncover a lot of these errors. My graduate classes in the MBA and the Masters in Accounting programs, basically I teach accounting issues and valuation. And that's one big issue for the PCAOB on mergers and acquisitions and asset allocation and whether or not assets are impaired, et cetera. It's a major issue for PCAOB, and I'm sure with non-public companies that get reviews or audits, it's even more of a problem. So these are areas where it comes into play. like abusive judgments and estimates. You notice in the audit reports, it says basically that, these are management's numbers, and I have a footnote that talks about management estimates, et cetera, et cetera. So the audit report does, push off onto management all of these issues, but when it comes down to a jury, the jury looks to the auditor regardless of what the engagement letter says. So if you're involved with that kind of stuff, you need to be careful. Revenue overstatement, we gave you one illustration of bill and hold, where the recognizing revenue before it's earned, which is the bill and hold, fictitious sales, which is just basically cooking the books, accelerating shipment of goods, channel stuffing, holding the books open at the end of period to get the subsequent period business into the current period, recognize revenue on transactions that are not actually sales. Ran into that back in the old computer days, where you would send, sell a computer program and have a 90-day right of return. We actually came up against that at an examination we did back in the 70s, where we were examining a firm that wrote computer software programs, and the people could buy them, but the people had 90-day right of return. So that if it was shipped out on December 31st, the people had until March 31st to return the product. So it really wasn't a completed sale as of December 31st. That's an illustration of situations where they're not actually sales. And when we dug into it, they did actually have a high percentage of returns on the software. Failing to book adjustments and recording transactions with no economic benefit to the company. Round tripping, where it goes out as a sale and then comes back, but where it's a wash transaction. Asset overstatements. Asset overstatements basically get involved where you're trying to create an environment that the a lender or the public, if it's a publicly traded company, or a lender or a publicly traded company would find acceptable. And different ways of doing that with accounts receivable, for example, delaying write-offs, manipulation of allowances. Oops, we need some profit. Let's cut down on our reserve for bad debts. Redating for aging. In other words, changing the scheme of 30, 60, 90 days. Maybe it'll make it 60 and 120 days, something like that. Inventory is an area that's open for fraud. Quantities on hand, just simply overstating the inventory. Improper capitalization, capitalizing items as inventory, which are not in fact inventory, but should be period costs. Even though, excuse me, the IRS suggests you do that with so-called 263A costs. But for accounting purposes, it's not appropriate. Delaying inventory write-offs. I had an audit example years and years ago. It was a bakery, a large bakery, and they had plastic bags with, and I'll show you how long ago this was. This is an illustration. It had the plastic bags pre-printed that they put the bread in and had 25 cents on it. And there are a ton of these things. So we're doing the inventory evaluation. We said, well, these bags have 25 cents on it. The bread is more than 25 cents. These are obsolete. They're out. No. We're going to get taken care of, et cetera, which in fact, before we left the audit, they did. They got all this inventory with 25 cents and paid somebody to just put stickers on it for the current price, which might've been 35 cents. So we didn't write them off. But those are the kinds of things that, had we not uncovered them, they wouldn't have written them off. Improper consideration for obsolescence. Assets, fixed assets, non-existent fixed assets, improper capitalization, failure to write down impairments. That's a big one in intangible assets as well, and extending useful lives. some situations with fixed assets. I don't think we go into it here. Let me just double check. One situation we had with fixed assets, again, on the audit environment, was with the CFO. Again, our bakeries had a lot of, one bakery had a lot of trucks. And so consequently, the trucks were being, retired and new trucks were being bought, et cetera, et cetera. And what we found out was the controller set up a bogus company. We didn't know at the time it was bogus, and he would buy these used bakery trucks for maybe $1,000 when their value was $500 or was $5,000 or $6,000. But he was the controller, and he was making deposit a check for $1,000 and write the asset off the books. And we noticed that this was going on. They seemed to be sold for less. So one day, one of the executives decided to take a ride over to the controller's house, and he said the house looked like a used car lot with used bakery trucks. And so what was happening is the controller was buying these trucks at used trucks at substantially less than used value, and turning around and selling them. So he may have bought them. They may have had a value of $4,000. He would buy it for $1,000 and sell it for $3,000. So the purchaser was getting a bakery truck for $1,000 less. So these are the kind of manipulations that go on in the fixed asset area. As I said, this guy was a CFO, so controller CFO, and there was nobody looking over his shoulder except the auditors. Intangible assets, improper capitalization, failure to write down impairments, and delayed amortization. When you value intangibles, there's a lot of assumptions that go into the valuation of intangibles. Over what period they will be benefiting the company, and when you acquire them. Is there contributory asset charges that should be offset? Are the goodwill, for example, or the assets, are they impaired in any way? And many times, particularly in non-public companies, these aren't even looked at by the internal accounting people or by the auditors that are, or accountants that are coming in doing reviewed financial statements or audited financial statements. We had one case a number of years ago where I got a report from an auditor, valuation analyst, who was doing the valuation of an M&A transaction. And it was submitted. Our client was the audit client of the firm. So we got this report as part of the audit work papers. And I got the job of reviewing the intangible valuations. And I was shocked by the time. This was a local CPA firm, well-known, and they had done such a shoddy job in determining the proper intangible values that when we got done, they had to change they had to add about 28 or 30 pages to the report to actually specify what they'd done and so forth. I don't recall if the auditors made any adjustments to the value, but that's the kind of thing that you have to watch out for. Again, it wasn't a fraudulent situation, but could have easily been a fraudulent situation if management wanted to pay off, if you will, an accounting or evaluation firm to come in and do the intangible valuations in their favor rather than in reality, because there's a lot that goes on in intangible valuations that are missed by valuation analysts and accountants and auditors. Liability and expense understatements, failing to record purchases, failing to accrue appropriate liabilities, recording expenses and payables in the wrong period. Again, it's like juxtaposing sales in the wrong period. Improper capitalization of expenditures. The other side of that is probably going to be in liabilities. Recording customer deposits as revenue happens frequently, absolutely frequently. And again, it happens in smaller companies more often, I think, than it happens in large companies. but again, it's an area for manipulation. Improper write-off of liabilities. We used to have an audit test where any liability is written off. We want to make sure it was a liability in the first place. Those kinds of things. Failing to account and accrue for contingent liabilities. This is becoming more and more of an issue because contingent liabilities such as litigation and so forth, there's lots of articles out relative to how to value contingent litigation, how to value contingent liabilities. It's not there yet, but it's getting there. But again, putzing with the liabilities is another way that you can make the financial statement look better by diminishing the liabilities and, of course, decreasing the expenses that are involved. Inadequate disclosures is an area in accounting and auditing which is missed frequently. The disclosures are typically missing, incomplete, fictitious, or misleading. Again, the disclosures are made to creditors. Disclosures are made to SEC if it's a publicly traded company, made to shareholders if it's a closely held company, and so forth. A lot of my cases are involving shareholder oppression and so forth. And one of the big areas where this comes out, inadequate disclosures comes out, is the fact that management is not adequately disclosing all information to the shareholders that are now asserting oppression. Examples: pending litigation is not disclosed. Warranty issues are misrepresented. I have a case right now that it's a lost profits case, but it involves, one of the things that's involved, it's used car operation, used car franchise that involves whether or not warranties are properly measured. The cost of warranties are properly measured. The potential exposure for warranties are properly measured. And this comes into a lost profits calculation. Related party transactions are omitted. Subsequent events are not noted. I don't know if you get involved with business valuations. I assume you do to some extent. And of course, the big issue these days is COVID-19, where you're doing a business valuation as of December 31st or January 31st. What obligation do you have relative to subsequent events not noted? I got a call from a friend who's one of my mentees, if you will, and she had an ESOP valuation as of December 31st of 2019. The trick was that this was an ESOP acquisition, but the actual transaction was not occurring until March 21st of 2020. And she said, the party said, oh yeah, we'll value it as of December 31st. And what obligation did she have relative to this subsequent event called COVID-19? And the issue came down to the fact that from our business valuation standards, SSVS1 and so forth, you have an obligation to disclose subsequent events that might have a material impact on the valuation. It doesn't change your December 31st valuation, but it puts the reader on notice. And what occurred in this particular case was that the trustee of the ESOP said to cover their butt, they didn't want to get in trouble with the Department of Labor. They said, okay, let's value it as of the date of the transaction, which was December 31st, March 21st, regardless of the fact that the company and the ESOP had agreed to December 31st. So subsequent events are important issues. Referencing non-existent events, I've not run into that one. Not addressing changes in accounting rules happens occasionally. And a lot of these inadequate disclosures happen with small, closely held companies. And government investigations are omitted from disclosures. Red flags, and this is the key one: violation of banking covenants. More importantly, If you're doing an investigation, it's what are the banking covenants, and taking a look at the areas that cover that the books and records, if you will, that are involved in the banking covenants. If they have a covenant relative to working capital requirements, you'll be looking at investigations in accounts receivable and other current assets, and accounts payable and other current liabilities. Issues with internal controls. The biggest issue I run into is that there are no internal controls. In this case I told you about earlier about the construction company, where the owner opened the bank statement. In fact, what had happened was that several years earlier, the accountant that was being sued had told management that management should be opening the bank statements and not the bookkeeper. In fact, management did not do that. So one of the issues that was resolved was that only losses prior to when the auditor or the accountant told them to open the bank statements would be considered as damages. Out of the $900,000, I think that excluded like $300,000 or $400,000 or $600,000, something like that. So the insurance company was looking at a somewhat smaller obligation than the $900,000. Poor financial performance is always an issue, and always a generation or a reason for financial statement fraud. Overly complex transactions, yes, they are an issue. I've had bankruptcies where there were partnership transactions, and the partnership transactions ultimately wound up being disguised sales as opposed to real partnership transactions, unrealistic forecasts and projections, particularly if they're given out to banks and so forth. Significant adjustments by the audit firm. That can be just poor internal control as opposed to being financial statements fraud, but it's something you want to take a look at as part of your investigation. And overly complex business and accounting positions. Again, these are all areas that if you're doing an investigation into financial statement fraud that you'll want to be looking at. Internal controls are the prevention vehicle designed to prevent problems to begin with. Segregation of duties, which is very, very difficult in small, closely held companies. And by small companies, I'm talking about, $1 million, $2 million, $3 million a year. Pre-approval of actions and transactions, and also subsequent approval. For example, that's an illustration where the owner should open the bank statement. Systems and access controls. So this is the ideal world of internal controls. Segregation of duties. I find it very difficult to have, number one, management to actually do suggested duties in order to spread out the segregation of duties. Open the bank statement. This owner of this company that I gave you earlier didn't open the bank statement for years, and when he did, he found out he was getting ripped off. The second situation, if the management doesn't want to do it, paying somebody to do it. Again, it's an additional cost to have sufficient personnel to segregate duties. Pre-approval of transactions. If you have a relatively few people in the accounting department or the purchasing department who's actually going to approve transactions, again, you need to talk the company into increasing their payroll in that particular area. What happens frequently is that in, let's say, the purchasing department, if there's only one or two persons in the purchasing department, the two people get to be buddies, and they may not do all their transaction reviews that they should do, et cetera, et cetera. Systems and access control, access to the systems. People you may not even be in the accounting and the finance area, but do have access to controls, like the IT department, can also be problematical in creating fraud. The one transaction, one case I had number of years ago. I forget all the details, but it was, there was somebody in the IT department, they worked in a bank, and the way they set up the program was that when they were calculating interest in savings accounts, it would carry out 3 decimal places. And let's say it turned out to be 0.257 cents. Well, what would go into the passbook or into the savings account will be the 25 cents. The 0.7 cents would go into another account. And that other account was controlled by the IT person. So he was, these 0.00x cents were going into this other account that was actually his account. And, you know, it was ultimately discovered that's what he was doing when he, lifestyle, et cetera, et cetera. Detection, designed to identify problems that already exist. Detection is external audits. Detections are monthly bank reconciliations, but they're good internal controls. And physical inventory observations are good internal controls. Now, I had one case which involved millions and millions of dollars, which I was called in afterwards. It was with a bank, relatively large local bank. And just recently, some of the officers did get jail time, but it was a bank that was loaning money in the early part of the 2000s prior to the 08-09 recession. And what was happening was a lot of builders and developers would come into the bank to borrow money, number one, to buy a tract of land, and number two, to finance a development. So what was happening was the loan officers were getting real estate appraisers, MAIs, to appraise the property. And they would appraise the real estate as is, but then they appraised the real estate as improved, which was a significantly higher number. But the process that they were using to value the real estate as improved was a real estate valuation rather than an actual operating valuation. And so consequently, a lot of these properties were overvalued, and there was really no support for the loan values. And of course, when everything turned down, you know, these loans blew up, and the bank basically went out of business. It was bought by another bank. But just recently, within the last 6 months or so, 3 or 4 officers got jail time. And to give you how bad it was, I was called in with a bank in Maryland, and they said, well, one of our loan officers wants to borrow $3 million, and here's the situation. He has a house. His house has attached to it a 7-unit assisted living facility. His wife takes care of it, and they want to borrow another they want to borrow $3 million and tack on 3 units to the 7 units, so they have an assisted living facility that was 10 units, and the house was on like 5 or 6 acres of ground, etc. The appraisal came in where the basic real estate appraisal, the house, structure, land, etc., was maybe $2 million, but they valued the assisted living facility at $1 million. But the valuation multiples and the discount rates were substantially far less than they should have been for that kind of an operation. So they didn't, I don't know what they ultimately did, but that was my report to the bank, is that the valuation was overstated. It was happening quite frequently in the early 2000s, and it's still out there as a possibility. Audit versus investigation. The difference between the two is audits are designed to find errors and improper application of accounting rules. And in many cases, they don't even do that. But that's what an audit is. The goal of the audit is to express an opinion on the financial statements, whether they're fairly presented. Emphasize fairly presented. Everybody thinks that financial statements that are audited are accurate. They're not accurate. They're fair. Audits are not designed to find fraud, but it can happen upon instances. They can get lucky. However, if there's an accounting malpractice case against the auditor filed, the jury does not believe that they're not designed to find fraud. The jury believes that if you're the auditor, you should find fraud, regardless of what your engagement letter says. That's why so many accounting malpractice cases settle before going to trial. I have one law firm that I work with that does a lot of accounting malpractice work. I get called in not for the accounting issues, but how to minimize the damage issues, because I know that the insurance company is going to say settle regardless. An audit is routine. Checklists are checklist-driven set of procedures that do not vary a lot between engagement. This is one of the big areas of failure with investigators who have an auditing or accounting background, is they still have this checklist mentality. They still have this black or white. How do I do this mentality? And it's not a matter about how you do investigation. It's how you be an investigator that makes the difference. So you've got to, if you're going to be an investigator, whether it's valuation, whether it's lost profits, whether it's investigating fraud, you've got to have this mindset of not what do you need to do, but what do you need to be, which is not checklist driven. Checklists are fine, but when you say, okay, fine, I did my investigation, the checklist is complete, you have not been an investigator. A financial investigation, forensic investigation is performed as needed. Procedures in an investigation vary substantially as they're tailored to the company and the matter. So that to say that there's a specific set of procedures that we use in all cases is a fallacy. We have to tailor our procedures to the specific facts and circumstances of each investigation. The company, the matter, the issue, and our procedures will continually change. As we get input from what we've been doing, our procedures are going to change. They're not going to be a checklist. Sampling is not as common in an investigation. I would disagree with that statement. And what I'm saying here is that you need to be specifically competent in statistics in order to do effective investigations. Now, where is sampling common in investigations? It's common in investigations to see where you should look, okay? In other words, what areas should you be examining? Maybe there was an expense went up or an expense went down by a significant amount of money. What some investigators do, and we recommend it, is you take a sample of transactions that caused that differential. Is there anything that indicated in that sample that there's a problem? If yes, then you continue with your investigation. If no, then you've got to take a look. You can pass. But again, I've got to emphasize the importance of statistics in investigation. One of the reasons is it saves time and money. Number two, it can be supported in a court of law. But again, they're not common. A lot of old school investigators will go in, and if there's a difference, they'll investigate 100% of the entries. But again, that costs that costs time. I mean, that costs, a friend of mine was doing an investigation. He sent his client a bill for $300,000. The client damn near died. What the hell did you spend $300,000 on? Irregularities in investigation not dismissed simply due to immaterial thresholds. Yes, investigation does not have a materiality threshold. So I think we have a question. Audits are supposed to find fraud. Audits are supposed to find fraud. The auditor has a responsibility, reasonable assurance about whether financial statements are free of material misstatements, whether caused by error or fraud. There's a difference between the issue is material misstatements. We go back to an earlier slide. We said that materiality is not an issue in fraud investigations. Materiality is an issue in audits. The auditor has a responsibility, reasonable assurance. The issue is when you look at that from a jury standpoint, the jury is reading that as absolute assurance. So that I think the statement that auditors are supposed to find fraud, that's what juries believe. But the auditor has saying the phrase in our standards that the auditor has a responsibility, reasonable assurance about whether financial statements are free of material misstatements, whether caused by error or fraud, I think is different than saying audits are supposed to find fraud. That's an issue that's litigated frequently. I don't know that I've answered the question appropriately, but that's maybe there's a follow-up. Summarize the reasons why audits don't find fraud. They're not designed to detect fraud. The auditor is not looking for fraud. If they find it, they've come across it in their normal audit procedures. Personal relationships with clients frequently happens where fraud is overlooked because way back in the days that closed out savings and loan associations back in the 80s, one of the issues was with Grant Thornton, where they were doing audits of S&Ls in Florida, and the partner in charge of the S&L audits in Florida owed the bank's money, owed the S&L's money. So he had a relationship that was contrary to what should exist when you're doing the audit. Lack of experience, common issue. I find errors in when I'm doing reviews of intangible assets and those kinds of things where the auditor gave the checklist to the junior and the junior was unable to discern, oh yes, they've got a discount rate. Whether or not, they were unable to evaluate whether or not the discount rate was appropriate. Willful ignorance, I have not run into that too much. Too much reliance on client representation. This goes back to the comment we made earlier where the auditor does everything in their power to indicate that these representations are client representations. Lack of professional skepticism. I think there's the issue that I run to there frequently is that there is skepticism, but there's not enough time or not enough money in the budget to actually pursue what they might find, might be skeptical of. Unconscious bias, that's similar to personal relationships. Overemphasis on materiality. I can't tell you the number of situations I've found where I've seen audit reports and audit files where immaterial, but when you put all the immaterial items together, they were all in the same direction as overstatement or understatement. Nobody puts all the individual items of materiality together. Lack of awareness and failure to adequately plan for possible fraud. We'll leave that to the auditors. Go on to the next one. Performing an investigation, public document reviews and background investigation, interviews with knowledgeable persons, confidential. One thing about interviews, if you are expecting fraud, the last person you want to interview is the person that you suspect is committing the fraud. You want to interview everybody around that person prior to interviewing the purported culprit, if you will. And interviewing is a skill in and of itself that takes some experience. But the key thing is that if you think Harvey Wallbanger is committing fraud, you don't want to interview Harvey Wallbanger off the bat. You want to interview people surrounding him beforehand. Confidential sources are the employees, analysis of physical electronic devices, if you can, undercover operations. Many times those are done by PIs, private investigators, licensed private investigators. Physical electronic surveillance, analysis of financial transactions. Like for example, this electronic surveillance and undercover operations and so forth. I have a PI locally that I work with and engage if I'm involved with an operation, to make sure that the undercover operations and surveillance is done appropriately. Analysis of financial transaction, of course, and confer with other professionals, private investigators. Also, other professionals in the field. I get frequent phone calls from people I know in the field and I've worked with for years and run questions by. I have 2 or 3 people that I routinely get a call once every couple of weeks with a question. Interviewing is a knowledge, systematic questioning of persons with knowledge of the events. And interrogation is what you will do after the interviewing, which is questioning the suspect, the target, and confront the suspect last, which we mentioned before. One of the purposes of interrogation is to get the perpetrator, suspected perpetrator, to admit to doing the fraud. Doesn't always work, but sometimes it does. Behavioral analysis, behavior. So lie is an embezzlement, concealment, or omission of information, falsification, or purposeful ambiguity. These are terms that you might use in your interview process. Lying as a stressor can often manifest into physical signs, and people will lie until the pain of their conscience becomes unbearable, or outside influences prompt them to reveal guilt. You see it on TV every once in a while, but they'll bring in when they're interrogating somebody. But if your wife knew what you did, what would she say? Well, I didn't say I did anything. Those kinds of things. People will often excuse their own lies, almost 100%. Liars feel guilty with anonymous targets. That's a situation, feel less guilty with anonymous targets. That's a situation where if the perp doesn't know the company, doesn't know the people he's stealing money from, etc., guilt is probably not high on his list. People with strong ties to the community tend to lie less for fear of exposure. We talked about that earlier, about people with strong ties to the community tend to lie less, but they also tend to steal less. While lying goes undetected, trusting others is easier. We do not have a history of lie detecting. Sometimes being misled is preferred to the truth, and we're brought up to be polite and non-confrontational. That's why, as I said before, interviewing is a specific skill that should be done by a professional or somebody with years and years of skills. Okay, if we have any questions, you can throw them in the chat box now. And while you're doing that, I will mention some references. The ACFE, if you're going to pursue investigation as part of your career, is an excellent organization to belong to. Getting your CFE designation is also an excellent designation to have. They concentrate on the mechanics of investigation, well worthwhile. The Johnstone book is a book which is a 30,000-foot view, but it shows it's in 1999, and we've had significant changes to our financial environment since 1999. So the book gives you a little bit of historical background. Darrell Durrell's book, Financial Forensics Body of Knowledge, is an excellent book to introduce you to the mechanics of and tools to actually do an investigation, worksheets, spreadsheets, calculations, etc. One of the examples, for example, is Benford's Law. Benford's Law goes back to the 30s. And if you're examining checks, for example, it gives you, Benford's Law basically says, determine the probability of any particular number being the first number in the sequence. For example, the number 1 in a sequence, whether it's check numbers or amounts of checks or whatever, has about a 33% probability being the first digit. And each of the digits are weighed out accordingly, so that if you apply Benford's law to check numbers, amounts, this, that, and the other thing, and there's a significant deviation, like for example, if number 9 typically, if I recall correctly, shows up about less than 10% as the first digit. But if you see 9 showing up as the first digit in 60% of the cases, that's where you want to be looking. That's where you want to direct your investigation. Mark Nagre has written an excellent book. He has another one out, Forensic Analytics, Methods and Techniques for Forensic Accounting Investigations. He has, this same book is now being written as a second edition. It hasn't been published yet. This is the first edition, but this goes into a great amount of detail as to how to apply statistics and some of the statistical and analytics, ratio analysis and so forth, to be used in forensic investigations. So I see we didn't get any questions, and I see we've completed our 100 minutes. So what do you want to do, Wendy?
Well, I'll put up this poll question here, and we'll get that answered. And like you said, we're fine for our CPE and our 100 minutes, so I think we can call it a day, and we will reconvene here, same bat time, same bat channel tomorrow.
Great. Tomorrow we'll be dealing with bankruptcy, which is also fun.
Awesome. Thanks, Dermot. Thank you so much for being with us, and we'll look forward to seeing you tomorrow. Attendees, thank you. Have a great day. We'll see you tomorrow.
Thanks.
Thank you. Bye-bye.